Welcome, I'm Sharon Calhoun, Managing Director at Vector Wealth Management, and today I'm joined by one of our Senior Wealth Advisors, Joe Grochowski. Welcome, Joe.
Well, thank you, Sharon. It's great to be here with you today.
Joe, today we're going to be diving into something I'm very excited about. It is the recently passed One Big Beautiful Bill Act. It was signed on the 4th of July, and this sweeping legislation brings significant changes to the tax landscape, especially for individual taxpayers. But before we dive into this, Joe, let me just set the stage. The One Big Beautiful Bill Act is an 870-page comprehensive tax reform package that builds upon the Tax Cut and Jobs Act of 2017. The act, as I think we should just call it today, brings significant updates to individual tax policy by permanently extending many of the Tax Cut and Jobs Act provisions that were previously set to expire at the end of this year. And of course, it aims to provide relief to middle-class families, incentivize savings, and quite honestly, it's trying to simplify certain tax provisions. While the bill, Joe, as you know, includes a variety of measures, today you and I are just going to be focusing on 5 key individual tax highlights that could directly impact our clients and their financial planning. One thing I do want to point out, Joe, before our listeners sit down and get ready for all these exciting highlights, is that the timing of these items can be different. Some of these items are going to start this year. Others are set to start in 2026. Some are made permanent, and yet others have an expiration date of 2028. So, Joe, are you ready?
I am.
All right, let's go. First up is the standard deduction, right? So we know the standard deduction has been significantly increased, and this is going to be, let's face it, a nice increase for those who do not itemize their deductions. So Joe, can you talk about the increases to the standard deduction?
So let's define what a standard deduction is. It's a fixed dollar amount that reduces the income you're taxed on, simplifying the tax filing process. The Act significantly increases the standard deduction for 2025 and beyond. For single filers, the standard deduction was $15,000 and is going to $15,750. For married couples filing jointly, it was $30,000 and is going to $31,500. For head of household, it was $22,500 and is now going to $23,625. Additionally, for taxpayers age 65 and older, there's an extra $6,000 deduction, bringing the total to $21,750 for singles and $37,500 for married filing joint filers. The caveat here is that the deduction will phase out at a 6% rate for single taxpayers earning more than $75,000 and phases out entirely at $175,000. And married taxpayers earning more than $150,000 and phases out entirely with modified adjusted gross income above $250,000. Let's use the example of a married filing joint household. Again, the phase out begins when that household's income starts to exceed $150,000. So if they're earning $250,000 or more, they're $100,000 over that threshold. When you multiply that times that 6% clip, that's where you come up with that $6,000 to completely offset that extra $6,000 deduction for people 65 or older. And so that's how the math works and why someone is fully phased out if you're married filing joint once your income exceeds $250,000.
Again, with this change, right, now we're seeing the standard deduction going higher for all taxpayers if you are taking the standard deduction versus itemizing.
That's correct.
Then the second thing is, just to kind of reiterate what you said, if you're 65 and older, you may be eligible for that additional $6,000 per person increase.
That is correct.
That is a meaningful, very meaningful tax savings that's going to be added on to your return assuming, to your point, that you're under those particular thresholds.
That is correct. And I would only add one other thing too, and that is that extra 6,000 deduction if you're 65 or older, that is for both standard deduction filers as well as itemized deduction filers. That's just another key point to be aware of.
Oh, excellent point. That's really exciting to see.
Absolutely.
Okay, number 2, SALT, state and local taxes, is what that stands for. So, truth be told, this was a tough pill to swallow when this went into effect. So, let me take a moment just to explain this. In summary, this is for taxpayers who itemize their deductions. It primarily impacts itemizers who tend to have higher incomes, who are paying higher state income taxes, and those paying high property taxes in states with high sales tax. So this was included in the Tax Cut and Jobs Act of 2017. And what it did, Joe, as our taxpayers know, is that it capped that deduction to $10,000 per year. A lot of taxpayers lost a very meaningful deduction on their Schedule A when this was enacted. So that happened at the same time the standard deduction was increased so that many of the taxpayers who would otherwise itemize their deductions benefited from the higher standard deduction. So what this act has done is it made changes again to increase the SALT tax for individual taxpayers who choose to itemize. So not only is the standard deduction being increased, just like what you just described, but now this SALT tax is being increased as well. So Joe, can you tell us more about that change?
Starting in 2025, Sharon, an increase in the SALT cap moves from 10,000 all the way to 40,000. A phase out of the $40,000 cap begins at modified adjusted gross income of $250,000 for single filers and $500,000 for joint filers. The deduction phases down at a rate of 30% above these thresholds until it returns to the original $10,000 cap for the highest earners. Starting in 2026, the cap will rise by 1% annually through 2029, after which it will revert to the original $10,000 level in 2030. So let's pause there for a second, Sharon, and let's use an example to help someone understand that phase out. So let's use a married filing joint household. Let's say their modified adjusted gross income is $550,000. That puts them $50,000 over the $500,000 threshold. When you take the $50,000 above and multiply that times that 30% amount, it comes up to $15,000. So that household, you start with the $40,000, and after reducing that $15,000, even in that example, that household could still utilize a $25,000 state and local tax deduction towards their total itemized deductions. As a result, the actual deduction available under the expanded SALT cap, if you will, could be significantly diminished or even eliminated for high-income individuals. Despite this, the law guarantees all taxpayers a minimum state and local tax deduction of $10,000, even if the income-based phase-out would otherwise reduce their deduction below that threshold.
So, Joe, again, that's a great summary of the SALT tax. And so just to kind of recap that again, going from 10,000 to a potential of 40,000, right? That is, again, a meaningful increase.
Yes.
For those taxpayers that fall below that income threshold where they can take that full 40,000.
Yes.
So we have that on top of, again, so enhanced standard deduction, enhanced SALT. So again, I think we can expect taxpayers are going to start to see some meaningful reductions on their return.
Absolutely.
So, great. Well, let's keep going then. Let's go on to item number 3. What has been made permanent is inflation index estate and gift tax exemption. Again, this was set to expire at the end of 2025. So again, this pertains to, again, the federal estate and gift tax exemption. Again, this comes up a lot when we're working with clients on their estate plan, right? Clients are concerned about, hey, are they going to meet that threshold? Are they going to end up owing estate tax?
So beginning in 2026, there will be a $15 million federal estate or gift tax lifetime exemption per individual and a corresponding separate $15 million federal generation skipping transfer tax lifetime exemption per individual. This marks a significant increase over the current 2025 lifetime exemptions, which currently sit at $13,990,000 and avoids the potential reduction of these exemptions that existed under prior law. Further, it is important to note that 3 points that have not changed. Number one, these exemption amounts will continue to be indexed for inflation. Second, the unused portion of a decedent's federal estate / gift tax lifetime exemption amount continues to be portable to surviving spouse. Third, the unused portion of a decedent's federal generation skipping transfer tax, that lifetime exemption is not portable to a surviving spouse. Finally, unlike the previous law, these new exemptions do not have a built-in sunset provision. In other words, these exemptions are permanent insofar as it would take a new act of future Congress and president to reduce the exemptions or otherwise change them.
So Joe, what we're hearing on the estate side is right now we're at 15 million per person. That is a significant change. And to know that it's made quote unquote permanent, as you referenced, again, knowing that it's permanent insofar as, you know, the president and Congress would have to make some kind of a future change to that. And it's also indexed for inflation. So
Correct.
That's fantastic.
Yes.
So I feel like what we're hearing from clients now is that they feel comfortable with the estate side, but it's the Minnesota estate tax side that is set at $3 million currently.
Yes.
Right? That was once at 1 million and then it phased in all the way up to 3 million. So there was a change in the past. But what we do know is that it did go into committee this year to look at expanding that amount even more.
Yes.
Unfortunately, that did not gain any traction in the committee. And so that went nowhere in this past legislative session. However, I am at least optimistic that because it made it to committee this year, perhaps in the future it'll make it again and maybe it'll gain some traction. So at least it's being talked about.
Yes.
But we have to be clear here that in the state of Minnesota, there is still a $3 million per person estate tax. So anything above that, unfortunately, is subject to Minnesota state tax. So we have to make sure that our listeners are well aware of that. And I know we work with all of our clients on explaining that. And we also work and talk about solutions for ways that we can avoid that.
Yeah,
so
very good point.
Okay, moving on. Number 4, we would like to talk about the charitable giving. So they have made some of, I think, 4 key changes to an individual's ability to deduct charitable contributions on their income tax return. So Joe, tell us about some of these charitable giving changes.
The first thing is they have increased the tax deduction for non-itemizers. So under the old CARES Act, which was effective in 2020 and 2021, individuals who did not itemize could still deduct $300 or $600 for joint returns of cash contributions to certain charitable organizations. That provision was allowed to expire, but now this act brings back this deduction and increases the amount to $1,000 for individuals and $2,000 for married persons filing joint. Remember, under this provision, it needs to be contributions to a public charity. So a donor-advised fund contribution would not apply, and this provision goes into effect starting January 1st of 2026. Point number 2, the creation of a floor for charitable deductions for itemizers. Prior to the bill, there was no separate threshold for deductions for contributions to charities. The bill provides that a person itemizing their deductions can only deduct charitable contributions to the extent that their amount contributed exceeds 0.5% of the person's adjusted gross income. So by way of example, if a person's adjusted gross income for 2026 is $100,000, the first $500 of donations would not be eligible for deduction. This limitation is effective starting January 1 of 2026. Point number 3, so the maximum benefit from charitable deduction is now limited to the 35% tax rate. Prior to the bill, charitable deductions served to reduce a taxpayer's income such that the benefit of the deduction was calculated at the highest marginal tax bracket for the taxpayer. The bill now provides that the maximum benefit for a charitable contribution deduction shall be calculated using a 35% marginal income tax rate, even if the taxpayer's actual rate is in that 37% bracket. This limitation also goes into effect January 1 of next year.
So Joe, let's just pause here for a second and let's just talk a little bit about that. So what you just said first was that there's going to be a 0.5%, right? So when you're doing the math on that contribution, so first you have to take your income, we have to figure out what that 0.5% is.
Yep.
That gets subtracted from your contribution.
That is correct.
Then secondly, to this point where you're talking about we're not able to use, if you are one of those high income earners where you are in the 37% marginal tax bracket, what this provision is saying is you do not get to use that 37% marginal bracket.
Right.
Rather, it's reduced one bracket lower down to the 35% marginal bracket. So in an example, so if you were to, let's say, give $100 under the prior provision or the pre-act, if you did $100, you would have a tax benefit of $37.
Yep, correct.
Under this one, it's $35. So what we're seeing under this provision, unlike some of the other ones that we've talked about thus far, where they all seem to be very beneficial, this one isn't quite as beneficial if you are a high income earner making charitable donations.
Correct.
Okay.
Yep, very well said.
Okay.
Thank you. Again, it's always helpful to use that example, and so I think our listeners will appreciate that. The final one, Sharon, larger donations to public charities are now made deductible. Prior to the bill, a limitation that capped cash donations to public charities at 60% of the taxpayer's adjusted gross income was set to expire and sunset this year, after which the limitation would have reverted back to the previous adjusted gross income. So now under the bill, the bill makes the 60% of adjusted gross income limitation permanent. So a little planning tip here on this point. The 0.5% floor and limitation of the charitable deduction to the 35% marginal rate are not effective for this year. So if a large charitable gift is being contemplated, consider making it before the end of this year. This would be a good year to take advantage of that before these changes go into effect for 2026.
Because of those two items that we talked about, those are not going into effect until 2026. Again, if you are thinking of doing a large donation or you have made commitments maybe to, various charities, this might be the year that you may want to consider making or bunching, as sometimes it's referred to, a large contribution on your return.
Yes, given these changes, that would make perfect sense.
Hey, real quick, thank you for tuning into this Well-Balanced podcast brought to you by Vector Wealth Management. We're a full-service, fee-based wealth management firm working with clients across the U.S. We do financial planning and investment management for individuals and families. If you are new to Vector and would like a portfolio and plan review, go to our website, vectorwealth.com, and click on the free assessment to get started. And now back to our show.
So we are moving on to our final and fifth update from the Act, and that is around 529s. So this is, again, 529s. We hear a lot about them. We work with our clients on these, whether it's for their children or their grandchildren. So there have been some very nice changes made to the 529 accounts. So Joe, why don't you walk us through some of those?
First and foremost, there is an annual per child distribution cap under previous law for K through 12 expenses that was $10,000, and that has now been increased to $20,000. So families who prefer private or specialized education options will particularly benefit from this, as this expanded cap allows for a broader financial cushion to address those K through 12 expenses. So when does that increase apply? That goes into effect starting in 2026. Now, in addition to increasing the amount that can be used for K through 12 expenses, there's now more leniency, there's more flexibility with how that $20,000 can be used for that child from the 529 plan. Previously, it was limited to tuition. Now, under the bill, funds can cover an extensive range of additional K through 12 expenses. So it could include curriculum materials, textbooks, workbooks, whatever, digital learning tools, tutorial services, online education platforms or subscriptions, and even educational therapies for students with disabilities. Standardized test fees, so for example, the SAT or ACT exams, dual enrollment tuition for college courses taken while a student is still in high school. Again, when do these changes apply? All of these go into effect this year after July 4th. So those are active today. Sharon, some other changes in the bill around 529 plans. Families can now use 529 plans for credentialing programs such as welding, aviation mechanics, and other trade certifications. Covered expenses for these programs include tuition, testing fees, and costs for books, equipment, and other continuing education items. This includes not only initial program costs, but also exam fees and continuing education required to obtain or maintain these certifications. This expands the scope of 529 savings to cover programs critical to skilled trades and high-demand technical careers, supporting individuals who choose alternative educational pathways. And again, this all applies effective as of the bill's passage date, July 4th of this year.
Wow, that was quite an expansive list, Joe, of the 529s.
Yes.
So again, if we just talk just for a moment a little bit further about this. So 529s have evolved so much since they initially came out. But one thing that I'm hearing you say with this new bill is that the piece that was kind of missed in the past is a lot of the trades, right? We don't hear enough about these, whether it's, auto mechanics or pipe fitters, or what this bill has now given is the freedom to, whether it's a college institution or whether it's a trade school. And not only will it pay for the tuition, but it has expanded so broadly to cover, again, whether it's exam fees and or recertifications. So, I mean, we just continue to see more and more broadening of the 529s. Quite honestly, Joe, I'm not sure how much further it could be broadened. Because what this is kind of telling me now is, hey, we don't have to burn this thing down by the time we're age 21, right? Because we know that there's another provision from a prior bill that allows dollars that can be moved into a Roth account. But now we're saying you can leave these dollars behind in the 529 to be used for future exam fees, continuing education renewals, things like that. So I think that is just absolutely fantastic. So I know that kind of concludes our 5 highlights, but there are other things too in this bill that we just simply don't have time for today. But I feel we've covered the ones that I feel our clients are asking about, the ones that pertain to our clients and to other listeners today. But there are other provisions in the bill, things that include, no tax on tip income up to a certain threshold. No tax on overtime pay up to a certain threshold. A deduction on auto loans if like the final assembly is made here in the US. There's certain things for bonus depreciation and things like that, accelerated depreciation if you are a business owner. So there's a lot of provisions in this 800, almost 900 plus.
Yeah, if you have the time to read 870 pages.
Exactly, yeah, 870. Trust me, Joe, I've been up a few nights late kind of combing through this. But so I truly feel that we've barely scratched the surface today. But the things that we did cover, right? So we talked about the increase in the standard deduction.
Yep.
We talked about the additional the additional $6,000 to your point.
Yes.
That is available whether or not you itemize or not. We've talked about the SALT increase, so that's fantastic. We've talked about the estate and gift tax increase, again, another plus. We talked about changes to the charitable giving. A couple of them are not maybe as fantastic, but that is the way that the bill reads. So we have to just share what is in the bill. And then, of course, your final one, which was covering the 529s and how that has, again, continued to broaden the usage of that. So that's fantastic. Joe, I would like to thank you so much for joining me today. It has been just a delight to visit with you, to share these updates. Any last parting thoughts?
No, it was wonderful to share this discussion with you today. I really appreciate it. And I hope our listeners also really thoroughly enjoy this information.
Yeah. And so I think, tax laws are constantly evolving, right? That is one thing we know about our job is that tax laws are always changing, but staying informed is the key to effective financial planning. So if you have any questions or need personalized advice, please don't hesitate to reach out to us here at Vector. We would welcome the opportunity. Yeah. So that is all for today's episode. If you found this information helpful, we welcome you to share it with others who might benefit. So thank you for tuning in. And until next time, thank you so much and stay safe.
Hey, thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investments.